decide you want to raise venture capital, you have to recognize that venture is kind of a drug. Once you're on it, you kind of have to stay on it. Otherwise, there are really, really bad side effects and outcomes. And even if you're on it, there are some things that you may not particularly like. And the reason, ultimately, it all boils down to time. So if you value time over control, then raise venture capital. But if you value control, if you value balance, if you value a lot of those other things, then like venture capital is probably not the right route for you.
Hello, everyone. Welcome again to Fearless Founders. We're excited to have Peter Harris, a longtime friend and an expert in the world of raising funds, as he has his own venture fund, which has morphed over the years. It is now called University Growth Fund, based in Utah, and he's very seasoned. We're excited to have him. And he's particularly got some great stories to share about how to be successful in business, how to raise funds, how to maintain the relationship with the investors so that you can have a great journey along the way and not hide, which happens a lot, particularly with my clients. So with that said, Peter, welcome. Thank you for joining us today.
Yeah, thank you so much for having me. I'm excited for today's conversation.
You're a good man. Thank you. With all of your experience, particularly in the world of talking to a lot of first-time startups, seeing so many pitch decks, being in so many competitions and watching them pitch and this and that, there's a whole 2-3 hours worth of content. But tell the team about how you started out in the first place and this whole Africa trip that you got those diseases that you caught simultaneously. I'm sure they want to hear.
Sure. So I'll tell you a little bit about my background, my story. When I was growing up, I really loved this idea of solving problems. And my dad at the time was a computer engineer. And he was working at Lockheed Martin, right? Really great, prestigious job in the arena of engineering. And I thought I wanted to be an engineer, and that engineering would be how I would solve problems. And then when I was in high school, he quit his job and started getting into real estate and business. And so I had this like huge change in my kind of orientation from engineering as a way to solve problems to business as a tool to solve problems. And I spent my summers remodeling houses, driving all over, looking at tax foreclosed properties, all kinds of stuff. Ended up buying a 44-unit apartment complex for $100,000, which was kind of a fun deal. Also taught me one of these key lessons that I think we can come back to later, which is this idea of like an earned secret and how important that is in investing and in business. But anyways, opened my eyes. And then I went to Spain and served as a missionary for my church there for a couple of years. And while I was there, was really exposed to quite a bit of poverty. And, I just kept thinking about all the experiences I had had growing up and using business and seeing the impacts that business can have when used appropriately, and thought there's got to be a way to take these business principles and use them to help solve poverty issues. So that kind of got my brain thinking. And then when I was at Brigham Young University, I got involved with a professor, Jason Fairborn, who had coined the term microfranchising. And the idea behind microfranchising is you take all of the same things that McDonald's has as a franchise, the systems, the supply chain, the brand, the marketing at like a head level, the well-developed product, all of those things, and you shrink them down to a package that can be operated by an individual living at the bottom of the pyramid. And so I started doing research with him. He had gotten funding for a 3-year longitudinal study comparing microfranchise versus standalone businesses versus microfinance. And so I, as an economics student, I did a lot of the underlying regression and data analysis work on that, published my honors thesis on it. And then when I graduated, my wife and I flew to Ghana, to the northern rural area of Ghana, and worked with him as consultants with this large multinational corporation. And our goal was to help this multinational corporation take products that had been successful in the US and other markets and bring them and package them in such a way that they would be successful in rural Ghana. And so we spent the summer kind of designing that. It ended up being incredibly successful for a large number of the micro franchisees that were working with us. They were predominantly women. My favorite story was one of our top sellers, this woman, Fatima. She was the oldest of 7 wives. So there's 7 wives. Each wife had at least 1 to 3 children. So she was kind of the matriarch over all of it and responsible for everything. At the time, she would wake up at 5 in the morning. She would cook all morning. Then she would go door to door selling dishwares. And then in the evening, she would basically have to cook and clean for the family and then cook some more to sell and then go to sleep in a mud hut and start it all over again the next day. So clearly hard work was not the issue. It was access to opportunity, right? So we came in, let her run, got her involved in the micro franchise. She cut her work hours from, probably somewhere between 12 to 16 hours a day of just straight manual labor to about 8 hours a day, 8, 9 hours a day. And she went from earning about $2 a day to earning $20 to $25 a day on any given day. So, tremendous impact on her and her family. She was able to start taking English classes and, a bunch of other things and writing classes, a bunch of other things that had a huge impact on her life. So it was an amazing experience. It wasn't without trial and tribulation. I ended up heading back a little earlier than I anticipated because at the end of my trip, I ended up contracting both malaria and typhoid at the same time, which frankly was terrifying. Being in northern Ghana, very far away, you're probably at least a couple hour plane trip from any major hospital. And feeling like some nights, I was I don't know if I'm going to make it out of Africa. Fortunately, my health improved enough that we could get out and travel back home and ended up being okay. But it was a wild experience. It was amazing. I got to work with some amazing people, build and design businesses, even got to grab onto the tail of a crocodile, which was a fun experience. So that's what happened there. And then when I got home, I ended up joining University Venture Fund full time. So the other thing I had been doing while I was in college was working at University Venture Fund as a student. And after I joined, the guys that had founded it, and kudos to them for getting it off the ground, they left to go pursue other interests. And so they brought in my now business partner, Tom Stringham, and we revamped soup to nuts, the whole fund and operations, how we recruit student interns and train them and teach them, as well as how do we source deals, evaluate deals, make investment decisions. And so, when I got back from Africa, started there full time and that fall, and have been doing that in one shape, form, or another ever since. So,
wow!
I know, what a story,
wow.
Huh?
Yes, it looks like you like to live on the edge.
I like to travel, and I like having new experiences. So that usually means that I end up on the edge of some places.
Yeah.
It's a beautiful thing. And now he has 3 kids. So it does ground him just a little bit.
A little bit.
Yeah. Congrats. My goodness, right? And the fact is, back then when you went, it was just the 2 of you, you and your wife, right? Mm-hmm. No kids at that time.
Yep.
Wow.
Yeah. Which was also a really fun, experience to do that with my spouse early on in our relationship. So
Ike knows about my camping philosophy about successful marriages, right? So that's what he did early on in his life. Peter, the fact that you 2 bonded and had to go through that is a great thing to seal your relationship that much better. I've always felt that's the way to do it. Congrats. Hey, so tell me about this journey now with how many thousands, tens of thousands of people that you've talked to, what you've learned from them. What can you share, whether it be a story or example of how? Let's start with how to raise funds for a business and why they should raise funds, why they shouldn't. Maybe you could talk about some of those elements. That would be kind of a fun start.
Mm-hmm.
Yeah. So
maybe
okay,
why they shouldn't. Yeah, why people shouldn't raise a fund to
so
get a.
so so raise a fund or raise funding? for
I'm
their
sorry,
startup?
funding to get
Okay.
investment. Why they shouldn't seek funding.
So yeah, in my opinion, so today 97% of businesses don't raise venture capital money, right? And my estimation is there's probably another percent in there that shouldn't, because they don't have. I mean, there's a lot of factors. So if you decide you want to raise venture capital, you have to recognize that venture is kind of a drug. Once you're on it, you kind of have to stay on it. Otherwise, there are really, really bad side effects and outcomes. And even if you're on it, there are some things that you may not particularly like. And the reason ultimately it all boils down to time. So if you value time over control, then raise venture capital. But if you value control, if you value balance, if you value a lot of those other things, then like venture capital is probably not the right route for you. And then there's a bunch of other factors that determine whether or not the company you're working on and the idea you have is one that merits venture capital money. Because if you don't have good alignment there, raising money will be a slog. And to the extent it's not a slog and you end up raising capital and you're successful, it's gonna be problematic. Like you're not gonna have a great life. So, and you ultimately won't be successful. So what are those things? Those things are, it needs to be a big market, right? If it's not like a really big market, then it's really hard to justify taking venture investment. And you have to have like a credible story of how not only is it a big market, but you're going to take an outsized portion of that market and display some like true monopolistic, power within that market. Because what we're investing in, if you think about the typical fund is probably about 300 million. Of course, now it's kind of scaled up to like 500 million. The typical Series A fund at $500 million, when they write a check into your company, they need to feel confident that you can return their entire fund off of just your deal, which means if they own 10% of the company by the time it goes public, after dilution and all the things that happen, because it just takes so long and so much capital to get there, they have to return $500 million off that one deal, which means you have to be worth $5 billion. And the to get to a $500 billion valuation, that means that you probably need to be doing about, at least 500 million in revenue, right? And so if you're operating in a market that's only $1 billion in size, you're half the market. Right. So you really need to have like these big markets. And even if you're in like a $5 billion market, having $500 million of revenue means that you're still sitting on 10% market share, which is a lot of market share. Right. And so you just have to be clear that like, that's what you're kind of signing up for. You're going to have to raise a lot of money. You're going to have to give up a lot of equity. You're going to have to give up a lot of control. The advantage, though, is that you get to move really fast. Other companies that don't raise the capital take decades to build what VC-backed companies can build in, half or a quarter of that time. And so, like that's the thing that you get. You get to grow a much bigger pie. You just get a smaller piece of it, but you get to do it in less time. I remember. We had like one of my favorite entrepreneurs is this gentleman, Josh Coates. He was the founder of Instructure. Before that, he was the founder of a data backup storage company that he raised only a little bit of money. I think he only raised like $2, maybe $3 million, and then sold it for somewhere around $70 million. And And so he owned like the vast majority. And I remember him getting into a big argument on a panel at one of our conferences with this other guy who was a founder of a company called Fusion.io. And Fusion.io was another like super successful company, raised tons of money, I think like north of $100 million, but grew to be worth a lot more. I think they ended up being worth $1 billion. I'd have to go back and look. Anyways, they had this argument on stage, right? And Josh was like, don't raise money or don't raise much, own more. And the other guy was like, no, grow something bigger, right? But in both cases, the one area where they agreed was the beauty of raising money is you get to move fast. And so it's just something that like I tell a lot of founders to think about, because like once you raise, you have now like set those expectations for the company that you need to build this into something big. And your next investors, like they care about what happens when you get big, and they care about like you meeting the milestones to raise more money and more money and more money and more money, because that's required in today's day and age to hit those kinds of valuations and outcomes. So that's a long way of saying, I think the first step is like sit back and think, is this something that like, one, I want to sign up for, and two, do I have the platform to really take it there? I just, chatted with a founder recently, and he has an amazing business that he's bootstrapped to several million in revenue, profitable. And he was very intentional. He was like, I don't know. He's like, up until now, I didn't have a pathway to build something big. And so I didn't pursue venture investment. He tapped into a huge new market with his product. And so then he was like, you know what, I think this actually does make sense at this point, and I'm willing to sign up for it. Right. But I think it's important to go into it with both eyes, wide open in what you're doing. And once you have that clarity, then it also becomes so much easier to tell your story to investors, right? Because you know the things that they're looking for. They're looking for big markets and the ability to capture a big chunk of that market. And you can start framing and your pitch around, why you're the right person to do it, why your company and your solution is the right solution, et cetera, et cetera, et cetera.
Fantastic. I've got lots of questions. And one of the comments I'm going to add to that is, I'm a believer in the don't raise unless you can absolutely multiply every dollar that comes in. But you also said, if you're willing to sign up knowing the size of the market opportunity and that you can have a significant land grab in a short amount of time, I think people still need to consider whether or not they're ready to take the emotional and mental beating that it's going to take when you have the compression factor of success with somebody else's money and the accountability you have for a responsible use of those funds, and yet everything has to be done fast. And so that's another preparation I'd have our viewers and listeners consider. You've got to be ready for the onslaught of pressure. Ike, what do you think of that?
That and many other things, like what I see, the founders, they don't understand the like intricacies sometimes. When a VC comes, they haven't educated themselves. Like I've done this myself as well. What I see the most cases is, oh, I want this valuation, and that's all I care about because I built this company so far and it should worth 5x, 10x, whatever my revenue. But there's many more variables in the equation that they don't consider. Like I'll give you, just yesterday I talked to somebody. He is Ike, I've been doing this for 4 years. They're over $10 million in revenue. I don't take any money to the to home, barely surviving. Physically, he's not doing well. And then these investors coming to him and say, look, your competitors got to $100 million, $200 million in 4 years. You're still struggling in the $10 million. He goes I asked them what the valuation, and they gave me 2x. of valuation. So I said that's the wrong question. Like ask them, when you guys put X amount of money, how fast can we go? When we exit, what is going to be my take? What's going to be your take? Just why don't you focus on those, like how you guys can work together to get some outcomes for both of you, rather than worry about right now my valuation is 2x. That's like one of the out of the million things. Valuation is just one item to talk about.
Yeah. Well, the other thing that you kind of hinted at there is, how often do venture funds also dictate how much a company should raise based on their fund size,
Mm-hmm.
right? Which is a personal pet peeve of mine, which is like, yeah, we have $100 or $500 million fund, therefore, we need to write a $25 million Series A check, and it's like, man, the company doesn't need $25 million at this stage, right? And if you give them $25 million, you're going to have to pay a much higher valuation in order to not suffer the same amount of dilution. And then they just have this huge milestone that they have to hit that's incredibly hard to hit. And so you've increased the risk for everybody across the board. And and then you add in the fact that when you have money, it's easier to be a little loose with the money, and not be as conservative and with it and as efficient as you probably need to be. And so I think it just sets up a lot of companies for frustration and failure too, where it's like, yeah, you focus so much on valuation and so much on how much has been raised, and not enough on what are the actual needs of the business to achieve the next milestone, and so on and so forth. Because the other thing in venture is it's kind of a momentum game.
Yeah.
You want to raise the A and then the B and then the C and then the D. And those are green flags when you do that. And even if, in my opinion, you have to sacrifice a little bit on valuation to do that, you'll end up in a better place, because I've seen so many deals, including deals I've done, where they did an A and then an A2 and an A3 and an A4 because they didn't meet the milestone to hit a B. And the investors are frustrated because we're putting in more money and they're not hitting metrics, and they're frustrated because they're not, they just keep getting diluted and diluted. And so in my opinion, it's far better to be very clear about, these are the outcomes we're shooting for. These are the milestones. Here's the capital we need to achieve it, and have reasonable valuations throughout.
Can I? Sorry, go ahead, Ike.
It's okay. Go ahead, Peter.
Hey, Peter, how do you balance how many of the portfolio families you beat over the head versus, okay, that's the way the dice rolls for these three companies. Those two are at least on par. That one's really crushing it. So as someone who manages all these hungry mouths who want more and more, ultimately money, how do you divide and manage the focus so that you are appropriately treating them at the level that they need? You're encouraging them, but at a certain point you got to move on. How does that decision come about, at least with your experience?
Yeah, I mean, it's a really hard conversation, right?
It is. Yeah.
And frankly, I've honestly gotten it wrong sometimes. In general, my philosophy is, and my experience has been, that your best performing companies don't really need or want your help, and they just kind of take off and do their thing. And sure, there are ways that you can be supportive and helpful, but if you really have true product market fit and a great team, things just kind of pull you along. And then you've got this middle group that's still figuring it out. They're kind of in the wilderness, and some of those will figure it out and move into the first category, and some won't, and they'll move into the third category, which is companies that, frankly, it's just really never going to work out. And so I try and spend a lot of my time in that middle group, where it's let's get you to a point where you're either moving up or you're moving out. And if you're in the group that's kind of moving out, then it's a lot of conversations around, hey, look, life is short. Just because this didn't work does not mean you are a failure. Let's find the next one, right? let's go after the next one and build that, instead of getting hung up and attached to a company that, you know, you spend decades at that never ends up going anywhere. You know, I think so. So a story on that, we very early on in my career, we backed this company. Actually, it was before my time that we invested. And then I came in and kind of took responsibility for that company. We were trying to help them. They had a CEO who is a phenomenal sales leader, just so good. And but for whatever reason, he was just like attached to this company and so afraid to leave and to shut it down and move on. And I look at it, and he's still running it. It's been 15 years since I first met him, still running it. Company still is doing maybe a couple million in revenue. I mean, it's basically flat from where it was, you know, barely breaking even. And I just look at that and I think, you know, what a waste. Like, he could have shut that down 14 years ago, started something new and put his incredible sales talent to like real work and gotten a ton more leverage on it. And I think like most VCs, we get this, right? It's in venture capital, you don't get penalized for your losses. You get penalized for the deals you missed out on, if that makes sense, because your downside is capped, but your upside is unlimited. And so, you know, from like a Vegas perspective, like you should be taking on lots of bets because you have unlimited upside and your downside is pretty much fixed. And so like when it really comes down to a given power law, like you're really rewarded for all the deals that you got into that ended up being successful, not the times you lost. So what that means is that a VC, I know I'm going to have losses, and that's okay, right? Like I may pound the table and say, hey, we need to build something big, and like keep trying in the time and being, you know, encouraging and pushing a little bit there. But I also recognize like that's just part of the game. Talking out of the other side of my mouth, though, I'll give you another story and where I kind of got it wrong. I thought the company was in this third category of like, let's wind it down. And I took the founder to lunch and I was like, look, I don't want you to waste your life like this other guy has wasted his life. This clearly isn't working. You know, it's been a struggle to fundraise. You've had to pivot many times. It's not clear that this new pivot that you've got is going to work. You know, at what point do you just like hang it up and then start something new? And anyways, at the end of the lunch, he was like, you know, I really appreciate the perspective and everything, but I have a lot of confidence in this new pivot. And he ended up being right. And the pivot took off. We ended up exiting the business and generating a great return on the investment. And so, you know, these things are hard, I guess is the punchline. They're hard. And it's tough to say. But, you know, I think if you're struggling to fundraise, you're struggling to land customers, you've got limited number of months left, you know, I don't think there is any, you know, shame in hanging it up and starting something new and trying again, if that makes sense.
Yes, fantastic. And beautiful stories to illustrate that. And Ike is grinning because of our experiences separately, but throughout this life of starting businesses. One of the things I've learned over time is that the choice of the investor, not just the company name, the VC brand, is as critical as is getting the money at the right under the right terms, because the amount of care and feeding and love and transparency by my board member, by my investor, and the confidence I get from him, her, is crucial to winning in this ragged, high intensity race. And as soon as I met you first time, 12 plus years ago, or more, I said, this is a good man. It is an important assessment of the person who's going to be part of the collective strategic team, not just the money. Ike, wouldn't you agree with that? What do you say?
100%. Yeah.
What's interesting about that is, so there's a fund called Correlation Ventures. They're very data driven. So you send them your materials, they put it into their algorithm. 2 weeks later, they give you a yes or no decision. But they have like one of the most robust data sets on performance of startups and VCs. And what they've shown is that it actually doesn't matter what fund invests in your company in terms of success. What matters is the person at the fund, to your point.
Mm-hmm.
And which was very counterintuitive to what they thought. They thought the original hypothesis was that if Sequoia leads your round, you will be more successful because it's Sequoia and it's the brand. It turns out, though, that you're far better off taking money from like a lesser known brand, but getting the right person for you and your company than with the brand. So anyways, super, super interesting, kind of your perspectives, having lived it, but then also having some data to back it up.
I love it. I will forever extol the virtues of Mark Gornberg, who has since retired from this world of investing. But he had invested into a startup 20 plus years ago that I was lucky to be part of. And we even had Will Hurst III. We had all the luminaries. But it was Mark who said, straight to my face, if you need someone and you are stuck and it's 3 a.m., call me. Call me and I will answer the phone. I will help you. And I have been in awe of that man ever since. And I knew then that with whomever he aligned himself with, that lucky person was going to have a huge amount of tailwind that Mark himself personally would provide, as well as a network. And I've never forgotten that. And it's crucial. And everywhere I go, I keep an eye out for, okay, go for the big name, but let's talk about the individual who's involved. So thank you. And in raising money, and you've seen lots of pitch decks and this and that and whatever, just maybe one item. What one item convinces you that the business is worth a second look, or it may be indeed investable? What is that one item that you look at? Because you're going to get a long list of market and this and that. But I'm going to ask you for one thing, because many of our listeners and viewers are wondering, should I even do it? And they could make that decision just based on your input, saying, if you don't X or have this, what would that be, Peter?
So the thing that I look for that I think is the most important is this idea of an earned secret. And, I mentioned that I used to do real estate investing in high school, and about that deal that I found. The reason I found that deal is because I spent like hours upon hours driving all over upstate New York, looking at dumpsters of properties, and it was looking and looking and looking at a lot of different properties, and then finally finding that one kind of needle in the haystack, and then immediately knowing this was like a once in a lifetime deal, right? But I had to earn it, right? If day one I had just walked into that deal, I may not have known it was a good deal or not. And so I had to put in the work and the effort to gain the experience, and I had to like put in the effort to go out and hunt down the deal. And so it was kind of this earned secret because nobody else knew about it. And that's part of the reason why I was able to buy this amazing property worth millions of dollars for $100,000, because there was no competition. And so I think about that a lot in terms of like the startups we back. I think great founders have this earned secret where they have paid the price to know something that not very many other people know, if anybody. And that gives them a massive competitive edge when it comes to, being truly disruptive in a space. I think like one of the classic stories is Airbnb, right? They pitched to a lot of VCs. A lot of VCs turned them down because they didn't see it. And yet these guys knew it would work. Why? Because they had actually done it and rented out their own apartment, right? They'd taken on the risk. They'd done it. They knew it would work. They had earned that secret. So I look for that a lot within founders. Like, do they have a unique perspective that allows them to solve the pain point that's being felt in their industry in a way that's unique and hopefully ultimately defensible as well. Because I just found that, you know, I don't know, we get into trouble when we back founders that they're kind of motivated by like, I want to build something big. And so they just chase after a big market, but they don't actually understand the underlying pain point at a real fundamental level. And because they don't understand the pain point, they're not able to build solutions that really work for customers and that add value to those customers. And then it just becomes really hard to get product market fit and build something big. So that's the one thing I look for. It can be challenging to figure out if a founder has, you know, this earned secret. So it's a lot of conversations. It's a lot of talking to customers and understanding what their pain points are, understanding the founder's background and their perspective on the space and what makes it unique, et cetera, et cetera. It's hard to just say you have X, therefore Y, you should, you know, get funding. But from like a qualitative perspective, it's something that I think about a lot on every single deal we do.
That's awesome. I think many of our first-time founders will be able to adjust their pitches, because even if sometimes they have that, they just can't articulate. They think it's all about the product or the market size, and that's what VCs care about. So I think that this was an awesome point. Peter, can I ask you something? Earlier you mentioned about raising more than you need sometimes, like what company needs. Can you tell us a little bit about that? Can you double click on that and say, like, at what stage, how much money, like what are the parameters for a founder to consider how much money they should be looking for?
Yeah, it's a great question. It's a hard question to answer, as I'm sure you know, because every company is a little different in terms of, you know, what milestones they need to hit and, you know, what their product is like and their business and so forth. In general, though, the way I think about it is at the pre-seed level, you need to build a product, right? So you need to raise enough money that you can build a product and land a customer. You know,
That's one customer or just like a handful?
Well, ideally a handful, but at least one, right?
Yeah.
You can't even get one customer, right, from your pre-seed round. Although a lot of seed investors now won't touch it until you're doing, you know, about $250,000 in ARR. So you need to be thoughtful about, like, however you're defining pre-seed. But like pre-seed is like, I need to build a product, I need to get customers.
Yeah.
Seed is I have customers, but I haven't quite proven out product market fit yet. And product market fit is one of those also like nebulous things that's hard to define. The way I think about it is every time I've seen a company that has product market fit, they start to see a shift from we're pushing a product to customers are pulling the product from us. And like, you can kind of feel it. And it's different in every single industry. But like in general, like when you've like cracked something that like really solves someone's pain point, they're coming after you to get that pain point solved, right? Yep. So just like things start to get easier. And what that usually means is that you're doing kind of $1 to $3 million in revenue or ARR if you're a SaaS business by the time you raise your Series A. So you need to be able to raise enough money to get to that point. And then from your Series A, the big milestone you need to prove out to investors is, okay, we have product market fit. Now, in order to earn like a Series B round, we need to demonstrate that we know how to do sales and marketing. We know how to go from founder sales to institutional sales. We need to show that we have like a playbook that works, because the Series B and the Series C and the Series D and so on and so forth, even though there are like certain aspects, like now you're company building and you're moving beyond like the founder interviewing every single employee and stuff, and like you've got cultural issues and so forth, every single round from the Series B really and onward is about putting fuel on fire, right? It's about let's grow this thing into something big. And so like you need those pieces put in place. I think the big challenge is that a lot of companies, if they raise too much too early on, they scale prematurely. They start trying to skip steps, right? They're like, oh, we're doing 250K. Let's just plow a ton of money into marketing and assume that we have product market fit. And then the marketing ends up being ineffective and they can't hit the revenue targets that they need to. Or like we need to adjust from, founder-led sales to institutional sales, and they do that too soon, too quickly. And they haven't figured out some of those more fundamental things. And then that sets them up for failure because churn rate goes through the roof, right? Because they're not actually solving a pain point for their customers. They're kind of they're kind of buying dollars for, like they're buying 50 cents of revenue for $1 of VC money, right? Instead of the other way around, right? And so, that's the way I think about it. In general, like you should be targeting roughly like 10% in your seed rounds of equity that you give up for that capital. Your Series A, they're probably going to want somewhere between 20 and 30% of the company. And that's because the Series A is like such like a pivotal point in the company where it's early enough VCs can take like a big chunk of the company, but not too early that they haven't figured out some of these things. And so it ends up being like this big inflection point for a lot of companies. And then subsequent rounds should be like probably Series B is like 15%. And then every subsequent round's about 10% of the company if you're hitting your metrics. And then it just becomes a game of like, how good are you at forecasting and how much money you have. And, seed stage is really challenging because you're just kind of in the wilderness until you figure it out, some product market fit. And hopefully you can do that before your capital runs out, which just reinforces this idea of being super capital efficient at that stage so that you can extend the time you have as long as possible until you can find product market fit. Anyways, that's my perspective. I'd be curious what you guys think.
That's great. I like your approach on the product market fit. That there's all kinds of metrics, and everybody has their own opinions. And our job here to the first-time founders get out of their heads and give them perspective of what others see the product market fit is. Like I've heard the internet is obviously full of different metrics, right? The 100 customers, or if it's a dollar amount, not the number of customers, or it's the churn, or it's the NPS score, which you can collect at the seed level. Just 5 customers you have is not going to give you any NPS score, right? NPS number. So I think they need to understand these stages from the point of view of the VC.
Yeah.
Fantastic. Peter, what is your target? Are you in the seed area, or you are A area in terms of your investment thesis, what you normally go into, so people know what University Venture does?
So, true to our name, University Growth Fund, we focus on companies that are growing. And so what that means to us is kind of Series A and up. So we'll do Series A, B, C, D, E, F, G, pick your letter. About 50% of our capital goes into companies that are at the growth stage, so doing north of 10 million in revenue. About a quarter of our investments go into early stage companies that are doing 1 to 3 million in revenue typically, and then a quarter goes into late stage pre-IPO deals, which like we backed Spotify when they were doing $1 billion in revenue and sold them when they were doing $5 billion in revenue, right? So just like a different level of scale, and we participate in kind of up and down that stack. We write checks in the like $250,000 to a couple million, so hopefully meaningful enough that founders are willing to spend time with us, but not so big that we're taking food out of the mouth of the other investors around the table, if that makes sense. We want to come in alongside amazing investors, just like you want to bring in amazing investors, right? So
Fantastic. And now I'm going to leap to the next portion that I've seen happen a lot as I have coached so many of these tech CEOs. There's a component of managing the relationship of the new board, the new investors, the lead investor, all of them. That I think is a skill that needs to be developed and communicated up front for
Yep.
them to be able to have a great building relationship versus a scared or hide from kind of a relationship. And the reason I bring this up is because there was one, my one story is there was an interested CEO tech. We had 2, maybe 3 meetings, and he wanted and needed coaching to be able to grow the business even more. There was some internal misalignment with his executives, and the lead investor said, "You may want to go and see if you can help this person." But ultimately, he refused, and down the road, maybe 2 years down the road, he had an exit. After the exit, he came and actually said, "Can I talk to you?" And I was able to interact with this good man, and he said, "Let me tell you my regret." He said, "I regret not having brought you on board. For my company could have sold for much higher with more ease, but I was afraid that as my CEO coach, you were an internal spy to communicate back up to the board all of my weaknesses and my failings and so forth. And hence I was chicken and I didn't engage you. I regret that," he said, in a beautiful, humble way. In the spirit of continuous learning, I think it's worth sharing. What does it take to have a great relationship when you are an investor and you're working with all of these CEOs? How can they be prepared now as they even contemplate taking in money? What's your take, advice?
Well, I think it starts with what we've already talked about, which is find the right investor, right? Do your reference checks on them, get a feel for not just when things go right, but when things go wrong. See if you can talk to founders that have failed, or not that the founders have failed, but the company has ended up not being successful. And how did the VC react and treat them and respond, right? Because I think it'll give you a lot of insight into them as individuals. One of the tests that I heard that I think is kind of an interesting one, and I don't know exactly what the parallel would be, but when evaluating a founder, to talk to their former assistant and see how they treat their former assistant. That usually gives you some really good insight into who they are as people. But I think that's step one. And then I think step two is acknowledging and realizing that once you raise money from an investor, they're kind of on your side. They want to be on your side, right? They've now invested a lot of money behind you. And when it comes to raising more money from other investors, they're going to face the same dilution that you are. And so like, I think what oftentimes happens is there's this like tension between founders and funders, that the founder, kind of views them as adversarial when they would have a lot more success if they engaged more with the investors that are already in the deal. And worked with them closely to achieve their goals, because there's a lot more alignment than they realize. And if you pick somebody who's good, right, when things are tough, they're not going to come to you and say, "Hey, you're out," right? As the CEO, we're replacing you. They're probably going to come to you and be like, "Let's talk about if you are the right person. And together, let's make the decision," right? If you're the right person, and if not, like, who is the right person? Let's find that person together, right? Because we have a vested interest. I know some VCs that will come in and just boot the founder, which again gets back to like being really thoughtful about your due diligence at the front end of it, and to understand who they are and how they operate. So yeah. And then, yeah, I mean, I feel like I have great relationships with a lot of our founders. Some will like call me late at night and they just, dump on me like all the things they're dealing with, and it's great. It's fine. And it's helpful because now I have like more insight into what's going on and ways in which I can help. Right. And that could be like, I need to be there for moral support, but it also could be like, okay, great. I'm going to roll up my sleeves and we're going to go, track down this customer or put on this event or, go pitch to a whole bunch of other investors and try to get them to put money into the deal. Whatever it might be. But if I'm not included in those conversations, I can't be helpful, right? My hands are kind of tied. So, I mean, it's partly on the founders, and frankly, it's also part on the investors to have the emotional intelligence to also build those relationships and establish that trust with those founders as well. So it's definitely a two-way street there.
It is. And in fact, I have learned over time, as I'm contemplating, I wish I had Peter Harris in my court many, many, many decades ago, where you are wise and you are good. And your advice about the self-awareness is also important on both sides. And I have seen the funder as well as the founder struggle as they all carry their own insecurities into the relationship instead of winning together as one team.
Mm-hmm.
And that has happened ultimately too many times because we all bring into relationships our own backstory. Ike, any question for Peter?
The comment, it might lead to more questions. Like Bino, I think you were with me when I learned from somebody that you had introduced me. He said board is an interesting dynamic. Board works for the CEO so that you can together elevate the company and grow, but board can also fire you. It's like there's nowhere else this dynamic exists. So the founder and CEO has to understand this conflicting dynamic, I think. So like while many founders that I know feel they can't, they have to be like they feel like they're walking on eggshells, because if they lose the trust of a board, you're done. Like there's no coming back from that. So they hold back a lot. But they also need to understand, like Peter, you said, look, they've invested, they want this thing to grow, and they, if I don't want to put your words, but your mouth, the investors can't be operators. They have 20 investments, and just the 4-hour meeting every 3 months is enough time. There's like so much more to do for the investors, that they're not here to come replace and take over from you and then start running the company. That's not their charter. So the founder also has to understand that dynamic. They want the best outcome, but as an investor, not as an operator, right? But how do we communicate this to the founders so that they are not only self-aware, but they're also investor aware? They put themselves in the shoes of the board members, I think, to be able to communicate clearly and then ask when they need help, and well, and then sometimes not overshare.
Yeah. Well, and there's also a certain element of like, if I've invested in your company, one of the last thing I want to do is run it. One of the last things I want to do is replace you. Because honestly, like if I have to go into a deal knowing that I'm going to replace somebody, like the CEO or founder, I'd rather just not do the deal, frankly. Like there's enough other fish in the sea. And so I think good investors, like that is the last thing they want to do. And in my experience, it is like what I described earlier, like they will sit down with the founder and together decide if it's the right move or not. But also there's this element of, if you have a deeper relationship with a lot of trust, you can be more open about the problems you're facing and find solutions together. And it does require a lot of trust on both sides, which I fully appreciate, like the tension and challenge there to creating. I just believe that if you can get there, you can unlock a lot of super interesting things.
Indeed, you can. And with that, Peter, thank you. Beautiful words of wisdom. You're fantastic. Any parting words to our listeners? Any thoughts that you have? Recommendations as an investor, as a professional who's seen thousands of these business pitches to investing? Any thoughts on that? Parting wisdom?
Just expanding a little bit more on that idea of creating, trust and intimacy between parties. I think so. One of the things that I found that has allowed me to be successful in my career is this idea of creating win-win-win outcomes for people. And I just feel like so often, because of our insecurities and fears, we end up being less creative than we could be around solving problems that create a win-win outcome for people. This is a very simple example. I mean, I could tell you story after story after story, because win-win-win is a core part of our organization and our culture. But we had an issue where venture funds would come in and they would poach our students, some of our very best students, and take them in and bring them into their programs, their internship programs. And on the one hand, that's great, because that's what we're there for. Like, we want to train students and give them access to amazing opportunities and help them, launch their careers. But it was also challenging because they were taking some of our best talent that made it hard to train the next group coming up, right? And then they would bring them into these internships, and they wouldn't have a very good experience because they had to kind of lower the standard to the lowest common denominator of their internship program. And so everyone was frustrated. We were frustrated because we lost them. The student was frustrated because they didn't get to that good of experience and exposure, no autonomy. And then the fund was kind of frustrated because they kind of viewed internships as more of a nuisance than a help. And so what I did is I went to them and I said, look, let's create this new program where we do externships. So my student wants to get your brand on their resume. They also want to have real experience. So what if we split their time? They spend 10 hours with you, 10 hours with us. You kick in and we double their scholarship amount. And you get somebody that hits the ground running day one. We will only send you really good people. You don't have to train. They can just add value right away. And that's resonated with so many funds and has solved our problems, right? Because now it's a win-win-win. I have a deeper relationship with these funds. The student has a much better experience, and the fund gets real value add out of those students. So I think it's just being creative, regardless of what your sphere is, around finding ways in which you can create win-win-win, as opposed to just saying no, we don't allow students to do other internships, or, bad mouthing those other funds, or whatever those other things might be. So anyways, that's just a principle that's really helped me out a lot in my career and given me a lot of perspective that's really helpful. And so hopefully that's helpful to your listeners as well.
Indeed. Thank you so much. I call it the spotlight at the end of the long tunnel becomes smaller as you get more desperate, as the cash runs out, as you have high churn. And if there's a way to kind of decrease the self-imposed pressure, all of a sudden the light gets bigger and there's more hope, more oxygen, and you can start thinking more laterally, more creatively to solve the problems. And we can spend an entire session on this one, Ike. This is a great topic. But you're absolutely right. I love the win-win-win. Thank you, Peter. You're great. We hope many people will come to you to ask for advice and ask for investment, knowing now how to do it properly. You've been a tremendous guest on our show. Thank you again.
Awesome to have you, Peter. Thank you.
Yeah, thank you for having me. It was a lot of fun.
Thank you. And everybody else, until next time, tune in, share this with your friends, please. We want them to all get help with the likes of Peter and his great counsel to you all. Until next time, bye-bye.